2 weeks ago, I did a video on a stock that I'm buying, and I told you guys about it. I told you it's an AMD 2.0 potentially for me, and I was talking about AMD from $150, $170 per share when it was called Advanced Money Destroyer. Now it's no longer destroying money. The stock is up a few 100%. To me, it has a setup similar to AMD. The stock has reported earnings, so I'm gonna talk about it in today's video, and I really hope you enjoy it as always. And this stock is Qualcomm. Qualcomm is down about 4% over the last year. It was down 4% in the after hours. Now it recovered to down 2% in the after hours. The stock has been going down with the semiconductors, but it's going down much less than other semiconductor companies because it's by far the cheapest semiconductor stock in the market. And it's one of the few semiconductor stocks that are doing buybacks and paying a 2.5% dividend. So to me, it's very interesting value proposition. Now, many of you guys likely use Qualcomm in every day of your life because the company owns the right to 4G, 5G, and soon to come 6G. So a lot of those devices that you have, they have to pay licenses and royalties to Qualcomm every single year for them to have 5G or 4G or soon 6G on their phone. So this is a very high margin, recurring revenue, royalty-based business model. But if you look at the company's earnings, they don't really look good on the surface. It looks like the company has declined year over year in revenue and earnings per share. They also missed on earnings per share by 2 cents. They beat on revenue, but they did miss on earnings per share. Now, if you look at it, take a deeper dive at the fundamentals, the company's handset revenue, which is mainly in smartphones, this is the cyclical part of the company that they're trying to diversify from. And this is why pretty much Qualcomm has done nothing in 5 years, because you have the data center chip stocks taking off, and Qualcomm isn't in data centers. They're mostly in smartphones, and smartphones are cyclical, and the company was not able to benefit from AI. So the handsets for them have declined 20% year over year. It's still by far their largest segment in terms of revenue. It's down 20%, and I'm going to tell you why. Now, automotive, which the company wasn't even in automotive 5 years ago, they went into the automotive sector. Now they're the largest supplier of automotive chips. This business is growing 61% year over year, and they have IoT, Internet of Things, such as the Google smart glasses and other smart glasses that they sell, and other gadgets. They all pretty much use Qualcomm chips. Well, this business is up 9% year over year. So the business is doing really well, but a lot of the growth is being masked and is being overshadowed by the declining handsets revenue. Now, the handsets or the mobile devices are declining for a few reasons. One of them is the memory impact, which is making devices more expensive, especially the premium devices. So a lot of consumers are going to the cheaper devices, and that's causing some margin compression on Qualcomm, as they believe that the memory problem has costed them about a 20% revenue decline, or about $1.50 in total impact. This is really, really big for the company, and this is one of the reasons why that has happened. The CEO said it's a temporary short-term thing. We are addressing it with price increases, so the company will no longer just be eating up the costs. They're going to start to raise prices, and that will make up for a lot of the lost revenues and margins over the last few quarters. Now, if you look at the company's non-handset revenue, it grew about 24% in total year over year. The company is guiding 60% revenue growth in non-handset revenue from 2026 and 2027. 60%, guys. This is absolutely massive for the company. And as the non-handset revenue grows even more, it's going to make less of an impact on the company whenever you have a decline in the smartphone business. And it's going to be pretty amazing for this investment, and it will likely get a massive multiple expansion once that happens. Now, if you know Qualcomm, you know that Qualcomm supplies a lot of the chips to Apple, and Apple is pretty much going in-house. They're going to be designing their own chips. So, for example, all the increase of next year will be replacing the Apple product revenues. And this is a headwind on the company that will pretty much be gone, hopefully, by next year. And the the new revenues will replace the old revenues. And after that, the company will have very little headwinds, mainly a lot of tailwinds. And I think the multiple expansion could potentially be pretty amazing. Now, the company is planning to enter the data center business pretty much in 2020, late 2026 to early 2027. The first one is they have some custom silicon contracts, two $1 billion plus custom silicon contracts. They did not reveal who were the consumers, but there's a lot of rumors that it's Amazon Web Services and it's also ByteDance from China. So that's really big for the company. And they're also planning to enter the accelerator and the CPU space. And the ways they're planning to do it is by focusing on something called HBC. HBC is a different type of memories than HBM. It's much more efficient in terms of inferencing. It's used in a lot of the smartphones and a lot of the automotive chips that Qualcomm specializes in. So Qualcomm is taking this technology and they're taking it into the data center space. I mean, if you think about all the things you're doing on your phone, and most of them have a Qualcomm chips, it's a lot of things, and it's very, very efficient. So the company is taking this efficiency, they bring it to inferencing in data centers, and it could potentially be a game changer as it does not rely on the expensive HBM memory. It mainly relies on HBC memories, which has produced some amazing results like 6x bandwidth per watt versus HBM and over 200 times capacity per watt versus the SRAM. And the analysts were shocked about those numbers, and it just really surprised a lot of people. And it's not like the company is just trying to get into it. They're not dreaming of going in data centers. The company already has contracts with Meta and Microsoft to supply their data centers with those chips that will be coming out next year in 2027 and in early 2028. And during the Investor Day, this is Mark Zuckerberg from Meta. He spoke at the Investors Day of Qualcomm, and he said, we first started on the Quest handsets. Then we brought Llama to Snapdragon, which is a Qualcomm chip, so people could run AI right on their phones. And today, Snapdragon is powering our AI glasses too. Now we're bringing their partnership into our data centers. So that's why our work with Qualcomm is so critical. They've spent decades figuring out how to get the most performance out of every watt. They're really good at it, and now is the right time to expand this partnership. And as I told you guys, there's so many uses that you use in the smartphone and a lot of those automotive and your watch and all these devices. A lot of them have those tiny Qualcomm chips, and Qualcomm has kind of figured out what AMD and NVIDIA, a lot of them are trying to figure out in inferencing, and they're bringing this technology to inferencing. So they have a partnership with Meta, and they have a partnership with Microsoft. So again, the company is not trying to get into data centers. They're not dreaming of getting in data centers. They're pretty much in data centers. It's just a time of shipping the product and just getting it going in general. So that's pretty amazing. Now, if you look at the company's guidance, they're guiding $18 plus in 2029. They pretty much doubled the revenue on Investors Day to $18 of earnings per share by 2029, and it doesn't include any buybacks. Now, the company has been expanding a lot. They recently expanded with Samsung. They supply more than 50% of all the Samsung with their own chips from Qualcomm. And Samsung has decided to expand as a partnership for a lot of the new Galaxy lineup across smartphones, watches, intelligent eyewear. So Samsung has the fabs. Samsung can kind of try to design their own chip, but the Qualcomm chip is so powerful that Samsung is still choosing Qualcomm as their partner for a lot of those things, and mainly in the watches and a lot of the Samsung gadgets and wearables that a lot of people use. So this is a major testament to Qualcomm's technology. But in the meantime, as the stock is going down, Qualcomm is trying to retire shares outstanding. It's one of the few companies buying back the stock, and they've been reducing it by about 5-6 million every quarter. This quarter they reduced it by about 9 million shares, and that's really good. Then they can reduce it more over time and return value to a shareholder. Now they also pay a dividend, which is good. The dividend is about 2%. So if you own Qualcomm, you get about a 2% dividend while you wait for all the headwinds from Apple to go out and the company to start generating data center revenue. You're getting paid about a 2% yield. It's not really high, but it's not the worst deal in the world, especially in the semiconductor space. So if we look at the valuation right now, the stock is trading at about 16 times earnings. I think 16 times earnings, guys, is very cheap for Qualcomm. And again, a lot of people look at the 12p and they say, I'm going to buy it at 12p. Maybe it will go to 12p, but 12p was when the company was pretty much 100% dependent on the cyclical mobile business. Now the company is expanding in a lot of the smart glasses and a lot of the data center chips. So I personally don't believe it's going to go back to 12 times earnings. So I'm going to really show you how cheap the stock is, I would say. I'm going to use, and again, it says they have confidence in the 2029 target of $18 plus. Now we're going to assume that they get to $18 per share, okay? And I'm going to assume that the stock is going to trade at about 18 times earnings. So 18 times 18, this is $324 per share. The stock right now is trading at about $150 per share. This is almost 116% on the upside over the next 3 to 4 years, excluding the 2.5% annual dividend that you get. In total, maybe that's like about 125% in 3 to 4 years. This is not a bad return at all. And that's assuming that, again, it trades at 18 times earnings and it doesn't get an AMD moment where it goes to 40, 50, or 60 times earnings, which is very, very possible. Now, for me, the worst case scenario is they just get the $18 and they trade at the current multiple of 16 times earnings. And this is very possible. So we take the $18, we time it by 16 times earnings. This is about $288 per share. So the current share price is about $150. This is about 92% on the upside over the next 3 to 4 years with Qualcomm. And I'm also getting a dividend. So that's about a 15, 17% annual return on 16 times earnings. I mean, sign me up. That's why I own the stock. That's why I believe it's undervalued. I did a much deeper dive in this video, and it's titled Why I'm Buying the Stock, 25-minute video. So if you're really interested in learning about Qualcomm, you could check it out. But I've been buying the dip on the stock. I want to continue buying the dip on the company, and I really like it for the next 3 to 4 years, especially if we have any slowdown in data centers. The company is just getting in data centers. So if we have a slowdown, I think AMD and NVIDIA will likely be much more affected than Qualcomm. So that was my thesis. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.